All right, hey guys, welcome back. This is day 3 of the investment project. You guys have been tracking. We started Friday, as you know, setting up the project and your account and everything. Then yesterday, hopefully you guys worked through the notes on investing and stocks and were able to work on the assignment a little bit and buy and sell a little bit on Investopedia. Today's agenda looks like this, if you don't already have it open. Let's see here. Yeah, there it is. Today's agenda looks like this. You guys have day 3 here. We're going to do lecture notes on bonds. I'm going to show you how to choose a bond. This is where you would go to buy if you were going to. Basically, instead of buying, we're going to have you print one out, one that you like. So I'll show you how to do that and show you how I want you to store that. And then I'm going to have you sketch out 3 age ranges of your investment life with level of risk for each, so on, and then have some time to play the game. So that'll be our day today. We are going to first jump right into, as you know, we're going to jump into, let me minimize this and scroll right up here. All right, so again, what you're doing is you guys are going to open the field. You're going to open up the field for bonds. And if you don't remember what that looks like this here on modified EXE. Okay, so you did investment yesterday right here. Investing, you did stocks notes right here. If you haven't done that yet, you need to go back to that video and do day 2. Because we're on day 3. So we're going to jump into just doing bonds today. So just opening up EXE, probably pause the video for a minute, go ahead and get yourself there, get that opened up, and then we're going to jump into the lecture. And so again, we talked about investing the other day, what that is, again, foregoing spending and consumption now for future savings, how that looks, what the options are, gave you a little bit of a brief overview of different options that we'll continue to unpack as we go along. Then we spent some time typing in notes and working on stocks, shares of ownership of companies that are supposed to do better, and then your shares grow in value, so on. You can sell them back, as you know. And today we do bonds. Bonds are basically, as it says here, are IOUs that represent debt. Okay, the government or corporations, businesses must repay to an investor. So bonds have 3 basic components. 1, the coupon rate, that's the interest rate that you're going to be paid. Maturity, that's the time on the payment for the bondholder, you or I, that'll come due. That's the maturity date. We'll see that in the website today. And then the par value, and that's the amount that an investor pays to purchase the bond, and that will be paid to the investor at maturity. So basically a bond is this. It can be any sort of community, a government, a country, a municipality, a corporation, business, what have you. They may sell some bonds in an effort to raise funds, and they will essentially borrow that money to raise the funds. So if we want to buy a bond, I give the company or you give the company the money. They give you an IOU, okay, a slip here that says they owe you after a certain period of time has passed, and it's already marked. It's kind of a contract sort of deal. And then when that's all done, they will pay you a certain % of interest. The reason people do this is because if you can get the right bonds, typically pretty reliable, you can get fairly low risk bonds, very reliable bonds. You can get them that pay certainly more interest than does money just sitting in a savings account. So we'll look at some of those today. So how do you know if the bond is good or not to buy? Well, when we look at the site today, you're going to see 2 bond rating companies, Standard & Poor's and Moody's, as it says here. And they rate the bonds on a number of factors, including the issuer, the company, the bond issuer, the company, the government, whoever it is, their ability to pay the money back, to make future payments. And as it says here, a high bond rating usually means that the bond will sell at a higher price and that the firm will be able to issue the bond at a lower interest rate. So basically, the more guarantee the company is to paying it back, the more sure bet it is for you, but you're also going to receive a lower interest rate. Again, the less risk is involved, the lesser interest rate. But you may not be looking for risk. You may be looking for an automatic payout at a certain time, and so that's an option. It just depends on who you are. Essentially, the way it shows here, if you see AAA and double and AAA rated bonds down to B, down to D, think of it like students. who score on tests or score in classes and get good grades versus bad grades. Students that get A's on tests and in classes, 4.0 students, are not very risky. And so if we were betting on an exam, is a student, which student's going to get the higher grade, an A student or a B or a D student? Well, most of us would probably bet on the A student. And so likely we would win, right, the bet, and we would get our money back, but we would also probably not get as much back because more people are betting on the A student. Those who choose to take some risk and bet on the D student, who might be capable of producing on the test but hasn't shown that, it is a risk, but fewer people betting on that. And if the D student does produce better on the test, they're going to get, the people who bet on the D student will get a higher payout because fewer people paid into the D student or bet on the D student. Same idea here. So it goes through advantages of bonds. They're desirable from the issuer's point of view for two main reasons. Once the bond's sold, the coupon rate for the bond will not go up, it won't go up or down. Unlike stocks, bonds are not shares of ownership in a company. So basically, the interest rate stays. So like some of you have asked in class, how do we figure out the interest rate? What about the stock market? Well, it's very volatile. And some of the higher risk things that we're talking about, higher risk instruments we're talking about, they change. They're fluctuating with the market. Bonds don't do that. Once it's set, the 4.5% interest. That's what it is. And when it matures 10 years from now, if that's what it is, then you would get 4.5% interest plus your money back. So that's one advantage there. A couple of disadvantages. One, the company must make fixed interest payments even in bad years. So if they don't do well, they still have to pay it back with that interest. So that's a problem. When it comes to maturity, they better have that money there to pay back. And two, if the issuer or the company, the business, the government, the institution, the municipality, whatever it is that's issuing the bond or selling the bond, does not maintain financial health, it's bound to see a decrease or a downgrade in their rating. So they'll have a tough time getting people to buy bonds in the future because they haven't proven that they are a sound investment or that they will pay it back. So that's bonds. I want you to stop those notes there. You can pause, finish them up, what have you. But again, you are typing in all this information, as you probably know, in this field here for bonds. So your notes are starting to thicken up a little bit. The next thing I'd like to do is I'd like to show you, as it says here on the agenda, I'm going to take you to this right here where it says go to fmsbonds.com. And what we're going to do is we're going to find a bond that you like. So I'm just going to kind of show you some of the details of that and then show you what I'd like you to do in copying and pasting it to a Word document and essentially showing you how I want you to save it in your portfolio. So here we go. We're going to go to FMS Bonds here. We're going to enlarge this. Hopefully this is picking up. We're going to go right here to FMS Bonds. I'd like you to click on this and it brings up this page. And I want you to come up here to where it says bond offerings. So what's available? There's a whole bunch of different things here at the top, across the top. It talks about the state that's offering it. Talks about the score by Moody's, score by Standard & Poor's, how many of those bonds are actually available because it's not an unlimited amount. The description of what it is, you can click on it. We'll click on one here in a minute. The coupon rate, which is the interest rate that you'll get. Remember, money just sitting there under your bed is not safe and it's not earning any interest. And money in a safe, simple savings account is only earning less than 0.5%. So this may be an option for you. Maturity tells us when it's going to mature. So for example, this one right here will mature in 2024. So 6 years from now. And then it talks about a couple of, this is the price, $97. This stuff just, again, kind of consistent with maturity, the interest rate. So we're focusing, you can not deal with these two columns here if you'd like to forget them. Click on them if you want to look into them, but it's not pertinent to what we're doing. So if you want to figure out which ones, you can click on any of these headings, state, and it'll give you, click on state again, it'll do alphabetize, Alabama, down to California. So if you're looking for something in California, here you can check these out. If you're looking for high-rated bonds, click on Moody's, there it is, and Standard & Poor's, it rates them. As you can see here, the top-rated AA, AA, AAA bonds, and how many, you can click on quantity. These are the ones, there's 10, or keep clicking on it. There's the one that has the highest amount of bonds available. And then descriptions, coupon rate, you click on it or double click. It'll show this is the highest one in Chicago, a 7% rated bond. It's a B rated by Standard & Poor's. It's in Illinois. I'd have to click on it. It looks like an educational bond, but there's 205 left, and it's 7% that's going to be due to you in 2044. So it's some ways off money that you'd be locking up, and it's $115 for that bond for each one of them. So if I'm going to click here, what I'd like you to do, if I'm going to click on one that's going to mature, let's take this one in Puerto Rico, for example. This is a AAA rated bond. There's 25 left, 5.25% interest rate, and it's due to be returned, mature in 2025. So in the next 7 years, not too far off. And it's $102. So what you would do if you liked this one, you would click on it and it opens up this page. I want you to copy and paste this much information here. You would then open up a Word document, paste it as I'm doing here. And then here at the bottom, just go ahead and do a little break there. And then here in the bottom, why I liked it. So essentially, I just want a paragraph of why I liked it. And let me actually do it for you. So this is where I just want a short deal. So maybe one of the reasons I prefer this bond is because of its rating with both Standard, S&P, and Moody's, right? And we would put AAA there. Maybe I go on to talk about also the interest rate of, it was 5.25, 5.25, something like that. So basically, you're just doing a paragraph explaining why you might want it, and maybe, and not just that, what you like about it, but why you liked it, and what are you planning to do with that money when it matures. So for example, so this is the other question. What do you want to do? Are you looking to buy a house in 7 years? So you're looking to have some money that you have set aside now and have it be more later? What are you looking to do? So when it matures in this one, 2025, or in 2044, what does your life look like then? Why is it you want it to mature then? What are you going to do? You plan on helping your kids get through college? Are you planning on buying a car in 3 years? Are you finished in 5 or 6 years helping pay off some student loan debt? I don't know, but that's what I need you to write here. Why you liked it, and what are you planning to do with that money when it matures? Okay. So from that point on, well, the next thing I'd like you to do is this. I am going to, let's see here. We're going to minimize this, minimize the bond page. We're going to come back to this right here. I'll go back to Google Classroom and enlarge it. Hopefully you're seeing all this. Next thing we have for today is sketching out the 3 age ranges of your investment life with levels of risk. So it looks like this. I'm going to bring up this right here, and hopefully you are seeing this. Yeah, there we are, right there. So what I mean by 3 age ranges is I would like you to simply do this. Okay, and as I did in class, maybe it's something as simple as I'm going to focus age 18 to 25, and I'm going to be fairly high risk. And then I'm going to do 25 to maybe 55. And I'm going to be moderate risk, maybe moderate to high risk. And I'm just making this up right now. Okay. And let me zoom in on that for you. Okay. It's literally just trying to figure out what your age ranges are. So if those are mine, high risk here, maybe moderate to high risk here. This is just me. Maybe you're low risk all the way across. Maybe yours is 18 to 30. I don't care. Then this one's going to be, for me, 55 to question mark. Some of you gave me till 80 or 83. Thanks for that. And then I'm going to say low to no risk. Low to no risk. So I'm just protecting, again, you saw this in my introduction to this project. I'm looking to protect my nest egg here. It's really, this portion of today's assignment is literally just a sketch like this. So you have an idea what age ranges you're going to be working with, your 3 investment life age ranges, and what your level of risk looks like. How risky are you as a person? Don't overthink this. Quit the share here. Don't overthink this. Literally, are you risky or risk averse? And we can talk about this when I get back. The very last thing I need you to do today is to play the game. That is, remember, you're going to Investopedia. You are playing the game, opening up Google Finance, and I don't think I have anything specific for you today. Yeah, you don't have to buy anything specific, but just play, have a little bit of fun with it, and I'll check back in on video with you tomorrow. See you later.